So you want to own Netflix. Good news. You don't need a broadcast license, you don't need to grovel in front of the FCC, and nobody's going to make you prove public interest, convenience, and necessity like the old television networks had to. The bad news is almost worse. To compete with Netflix, the real entry fee isn't paperwork. It's $20 billion a year, every year, just to keep the shelves stocked before you've made a single dollar back. What is Netflix actually selling? Why does a company that makes almost nothing physical carry a market cap north of $398 billion? And why did Wall Street once erase $50 billion of that value in a single afternoon over the loss of 200,000 subscribers? Stick around. Start with the real cost of getting in. Netflix's own 2026 guidance puts content spending at roughly $20 billion for the year, up 10% from 2025. That's not a licensing fee to a regulator. It's the price of a full slate of competitive original programming, and it buys you nothing guaranteed. There's no government body handing out a streaming charter. What there is instead is a brutal informal entry test. You need enough capital to fund years of losses while you build a content library dense enough that people stop asking, wait, is that on the other app? Quibi tried it with $1.75 billion and folded in 6 months, in December 2020. Having burned through most of that on shows nobody watched on their phones. $20 billion a year isn't the price of admission. It's the annual membership fee, forever. Building from nothing is one option. The other, cheaper option is to just buy your way to relevance. And Netflix itself just proved it. In December 2025, Netflix agreed to acquire Warner Bros. Discovery's studio and streaming operations in an all-cash deal worth roughly $83 billion. At $27.75 a share. Instead of spending years building out a film studio, a prestige TV pipeline, and HBO's back catalog from scratch, Netflix simply bought a company that already had one. Building takes a decade. Buying takes a boardroom vote and a very large wire transfer. Now look at how differently this same business runs depending on which country you're standing in. In the United States, a standard Netflix plan runs around $17 to $18 a month. In India, the entry tier is closer to $2.50. Same platform, same login screen, radically different price, because in India, Netflix is competing against Disney Plus Hotstar and free ad-supported apps for a customer base that simply won't pay New York prices. So Netflix built cheaper regional content, cut the US price into a fraction, and still turns a profit. Because in some markets, the real product isn't prestige television, it's cheap volume at scale. Here's the stat that surprises people. Despite years of price hikes, and despite a very public 2023 crackdown on password sharing that analysts predicted would trigger a mass cancellation wave, Netflix's monthly churn rate sits at roughly 2%. People complain loudly about price increases online and then quietly keep paying. The password crackdown alone added millions of new paying accounts within months of rollout in 2023. Because it turns out threatening to cut off your brother-in-law's free account is a more effective growth strategy than any ad campaign Netflix has ever run. What's the safety net if a show flops or a market turns hostile? There isn't a government backstop here. No FDIC for content spending. What Netflix has instead is diversification and insurance in the boring, literal sense. Production insurance policies that cover shoots shut down by accidents, weather, or a lead actor getting hurt, plus a subscriber base spread across more than 190 countries so that a soft quarter in one region gets absorbed by growth in another. What that insurance does not cover is bad taste. Nobody reimburses Netflix for greenlighting a show nobody wanted to watch. So why would anyone sink $20 billion a year into content that half the audience forgets existed within a month? Here's the mechanism nobody explains clearly. Netflix doesn't expense that $20 billion the moment it's spent. Content costs get amortized. Spread out as an expense over the years, the content is expected to generate value, not booked all at once. Cash goes out the door immediately, but the hit to reported profit gets smoothed across several years. That single accounting choice is the actual engine of the business. It lets Netflix spend like a studio while reporting earnings like a software company. Picture it simply. Netflix pays $100 million for a splashy original series. Instead of subtracting the full $100 million from this year's profit, it might amortize it on a declining schedule, something like $40 million in year 1, $30 in year 2, $20 in year 3, $10 in year 4, based on when the show is expected to actually get watched. So the year the $100 million leaves the bank account, The income statement only shows a $40 million expense. Profit looks healthier than the cash flow does. That gap is where the profitable streaming giant narrative was manufactured, years before the profits were real. Now scale that up to the size Netflix actually operates at. With a content budget near $20 billion annually, spread across a library with thousands of titles amortizing on staggered schedules, Netflix reported full-year 2025 revenue of $45.2 billion and an operating margin near 30%, even while continuing to spend tens of billions building next year's catalog. That's not a coincidence of good taste in scripts. That's the amortization schedule, doing exactly what it's designed to do. Let a content-spending machine look like a cash-generating machine on paper, years before all the bills actually come due. The second business inside the business is advertising, and it's the newer, faster-growing one. Netflix's ad-supported tier launched in late 2022, and by 2025 it had generated more than $1.5 billion in ad revenue, roughly 2.5 times what it made the year before, with management guiding toward a rough doubling again in 2026. The mechanics are simple. A subscriber who won't pay $18 a month will often pay $7 if they accept ads, and that subscriber then becomes a second product sold separately to advertisers who want eyeballs on Stranger Things and NFL Christmas games. Multiply a lower subscription price against millions of price-sensitive households. Add ad sales revenue on top, and you've built a second income stream out of the exact customers who were about to churn out the front door for being too expensive. Not every chapter of this story is a clean win, though. In September 2011, Netflix tried to split its business in two. DVD by mail would become a separate service called Qwikster, streaming would stay under the Netflix name, and customers would need two logins, two bills, two apps, for a company they'd previously used as one. The backlash was immediate and brutal. Netflix lost roughly 800,000 subscribers that quarter. The stock, which had traded above $290 a share that summer, collapsed to around $53 by November, a drop of more than 75% in a matter of months. Netflix killed Qwikster before it launched. Nobody went to prison over it, nobody got fined by a regulator. The only casualty was several billion dollars of shareholder value and a lot of executive embarrassment that got quietly rebranded as a valuable lesson. The bigger crisis came in April 2022. On April 19th, Netflix reported its first subscriber loss in more than a decade, roughly 200,000 accounts gone in a single quarter, and warned investors to expect an even steeper loss ahead. The next day, April 20th, the stock fell about 35% in a single trading session, wiping out somewhere around $50 billion in market capitalization before lunch. Analysts who had been calling Netflix a buy the week before scrambled to downgrade it the same afternoon. The irony that stuck around longest: password sharing, the exact problem Netflix had tolerated for a decade because cracking down felt too risky, turned out to be the fix that stabilized the business a year later. The company spent 10 years afraid of a solution that, once it finally used it, added millions of paying households almost overnight. Pull the lessons out of that stretch and they're not complicated. First, subscriber growth built on tolerated freeloading is not the same thing as a healthy business model. It's a ticking liability that eventually has to be monetized or written off. Second, markets don't punish you for bad news. They punish you for bad news that contradicts the story you told them the week before. Third, the fix that feels too aggressive to attempt is often the one sitting there the whole time, waiting for the stock price to fall far enough that the board finally approves it. Here's the stat that reframes the entire risk profile of this business. The biggest threat to a streaming giant was never piracy, and it was never a scrappy startup competitor. It was self-inflicted strategic panic, decisions made by the company itself, at speed, under investor pressure, that torched more market value in a single day than any external threat ever managed. Qwikster was self-inflicted. The 2022 crash was triggered by the company's own forecast miss, not a hack or a scandal or a rival's masterstroke. Zoom out, and the deeper structure becomes obvious. Netflix isn't really a technology company, and it was never really just a content company either. It's a financial engineering exercise wrapped around a recurring revenue subscription base, using amortization accounting to convert massive upfront cash spending into smooth, investor-friendly profit numbers, then using that stock market credibility to raise cheap capital and buy actual studios outright, which is precisely what the Warner Brothers Discovery deal represents. The business exists because streaming subscriptions generate the most predictable cash flow entertainment has ever produced. And predictable cash flow is the one thing Wall Street will pay almost any multiple for. So what does actually owning a piece of this look like? At two very different scales. Buy 100 shares of Netflix stock at recent prices around $350 a share. Post-split. And you've put down roughly $35,000 for a sliver of a company generating tens of billions in annual revenue, with no operational headaches, collecting whatever the board decides to do with buybacks and share appreciation. At the other end, try to build a rival platform from scratch. $20 billion a year in content, hundreds of millions more in streaming infrastructure and licensing, 3 to 5 years before subscriber revenue even approaches your annual burn rate, and realistically a 9-figure loss before you find out whether audiences even wanted what you built. One path costs $35,000 and requires patience. The other costs a small country's GDP and requires a very high tolerance for public failure. In the end, the real business of Netflix was never movies or shows. It was convincing millions of people to auto-pay a subscription every month for something they could cancel anytime and almost never do. Funny how that works out.